What is India US digital tax deal? Recently, India and the US agreed on a transactional method on equalization levy or digital tax on e-commerce goods which would take effect on April 1st, 2022. The Office of United States Trade Representative USTR had previously said in January 2021 that digital services taxes imposed by India, Italy, and Turkey are discriminatory against US firms. What is digital services tax DSTs? These are the taxes that have been imposed on the revenues that is certain businesses make from provision of certain digital services. Digital conglomerates like Google, Amazon, and Apple, for example, the Organization for Economic Cooperation and Development (OECD) is now hosting discussions with over 130 nations to adjust the worldwide tax system. One objective is to handle tax issues that have arisen as a result of economy's digitalization. According to some analysts, a tax policy aimed at a specific industry or activity is likely to be unjust and have complicated repercussions. Further, the digital economy is inextricably linked to the rest of the global economy. Let's go for the background check for these all the things. On October 8th, 2021, 136 nations, including India, agreed to impose a minimum corporate tax rate of 15% as well as an equal method of taxing major firms earning in the markets where they have earned global deal. The agreement calls for it all digital services taxes and other unilateral actions to be repealed. Following that, the United States, Austria, France, Italy, Spain, and United Kingdom agreed on transactional approachment to current unilateral measures while adapting Pillar 1 tax treaty around the world. It designated to address some of the world's largest firms' low effective tax rates, including big tech giants like Apple, Alphabet, and Facebook. Multinational companies such having worldwide sales of USD 868 million dollars would be subject to the global minimum tax rate. Pillar 1 minimum tax and subject to tax rules. Governments may establish whatever local corporate rules rate they wish, but if the corporations pay lower tax rates in a specific nation, their home governments might top up their taxes to 15% minimum, removing the benefit of transfer earnings. Pillar 2 reallocation of additional profits to market jurisdictions allows nations where revenues are produced to tax 25% of the largest multinational so-called excess profit defined as a profit exceeding 10% of the revenue. What is India-US agreement? India and United States have agreed to apply same condition as agreed by the United States, Austria, France, Italy, Spain and the UK, United Kingdom to 2% equalization tax on e-commerce services and the United States trade action in response to the equalization levy. The fee will be placed in until March 2024 or until the implement of the Pillar 1 of the Organization for Economic Cooperation and Development OECD agreement on taxing multinationals and cross-border digital transaction, whichever comes first. India and United States will maintain communication to ensure that both parties have a clear understanding of their respective commitments and to work out any remaining differences of opinion via constructive disclosure. The United States will end trade tariffs it has declared in reaction to the levy and will not take any additional measures. And how important is India US agreement? It benefits India since it can continue to levy the current 2% levy with certainly until the Pillar 1 takes the effect, as well as a pledge from the US side to end the planned trade measures and not to impose new ones. As India must roll down equalization levy EL 2.0 in some way beyond Pillar 1. This will assist reduce tax losses coming from the internet transactions. It is important to remember that Pillar 1 only applies to enterprises with global revenue of more than 20 billion euros or top 100 corporations. Thank you very much for watching.